the smartest investor on earth, spent 3 years getting mocked. Bloomberg ran the headline, "Berkshire's Cash Hoard Baffles Wall Street." Analysts wrote lengthy notes about capital misallocation. Financial Twitter did what financial Twitter does. And through all of it, the company kept piling up treasury bills like it was getting paid to be patient, which, it turns out, it was. By the first quarter of 2026, Berkshire Hathaway was sitting on $397 billion in cash and short-term treasury bills, the highest liquid reserve in the company's history, according to Berkshire's first quarter 10Q filing. More than the combined cash holdings of Apple, Amazon, Alphabet, and Microsoft. Enough, per analysts at Barchart, to acquire 497 of the companies listed in the S&P 500 outright. And that pile was not sitting idle. The capital was producing annualized interest earnings approaching $12 billion as government securities continued to deliver yields of around 3.7%. A $12 billion business, built entirely out of doing nothing. Now, contrast that with this. The median balance respondents report having in emergency savings right now is $5,000. Just half of the $10,000 reported in 2025, and nearly 1 in 4 Americans has no emergency savings at all. Between $397 billion and zero is the entire distance between the investor who wins and the investor who gets carried out on a stretcher. And the gap has almost nothing to do with picking the right stocks. It has everything to do with something almost no one explains directly. Not returns, not diversification, not dollar cost averaging. It's about what cash actually is, the physics of it. And I mean that literally because once you understand the mechanics, the way you think about every dollar you hold will permanently change. Here's the thing. Cash is the most misunderstood asset in most people's portfolios. Half the internet treats it like a sin. Every dollar sitting in savings is a dollar not working. The other half holds cash out of pure fear and calls it prudence. Both of them are wrong. And I'm going to show you exactly how, using real data from 2022 through right now, because the last 4 years have been the best possible live case study in what cash does and doesn't do for the investor who understands it. By the end of this video, you'll know 3 things. 1, what cash is actually doing while it sits there, that no return calculator shows you. 2, the exact moment cash transforms from passive safety net into an offensive weapon. And 3, how to think about the 3 distinct roles cash plays in a serious wealth building strategy. Because treating them as one undifferentiated pile is how you get it wrong in every direction simultaneously. Let me start with a concept. There's something in options trading called optionality. When you buy a call option, you're not buying a stock, you're buying the right but not the obligation to purchase that stock at a specific price at a future point in time. You pay a premium for that right. And the value of the option is directly tied to how much time remains before it expires. Cash is an option, but it's a free option. It doesn't expire on a fixed schedule. It doesn't cost you an upfront premium. It doesn't force you to act. It just sits there, open, available, a permanent right to deploy into whatever asset class, emergency, or opportunity presents itself. The moment that moment arrives. The problem is that most people price their cash at zero. They see $1 in savings and they count it as dead weight. They calculate the opportunity cost against an idealized market return and they feel guilty. They don't account for the option value. And the option value is enormous, but only if you understand that what you're doing by holding cash is quietly waiting to exercise it. Cash doesn't wait, it aims. That's the frame. Hold on to it. In a few minutes, I'm going to show you exactly how cash becomes a weapon that lets you acquire assets at a discount that almost no one else at the table can access. But first, I want to walk through what happens to the person who doesn't have it, because this part is far more brutal than most financial content will admit. You think the problem is losing money in a market downturn. That's the wrong problem. The real problem is being forced to sell when you can't afford not to. Let me tell you about Marcus. He's 39. He's been disciplined. He's been maxing his 401k for 8 years. He also has about $80,000 in a taxable brokerage account. No cash cushion. Because he read somewhere that cash in a savings account loses to inflation and every dollar should be working. His financial advisor told him to stay fully invested. He did. Then 2022 happens. Inflation hits 9.1%. The Fed hikes rates 11 times. US stocks enter a bear market, the S&P 500 down 25% in the first 10 months of 2022, due to high inflation, rising interest rates, and related factors. Marcus's brokerage account in the $80,000 is now worth $60,000 on paper. And then his roof starts leaking, his car needs a transmission, and he's between contracts at work for 6 weeks. He needs $18,000 right now. He has two options. He can sell stocks at a 25% loss to raise the money, or he can put it on a credit card. And where does the average credit card APR sit today? For all credit cards, the average APR in the first quarter of 2026 was 21%. 3 times what a mortgage costs. 3 times. Either way, Marcus is paying for the absence of cash. He's either selling assets his future self desperately needs at the worst possible moment, locking in losses that UBS calls bear market damage, or he's borrowing money at 21% annualized to fund a temporary shortfall. When an investor sells part of their invested portfolio during a market drawdown, they not only lock in otherwise temporary losses, they also prevent their assets from fully participating in the market recovery and future gains. That's not a market problem. That's a cash problem. The portfolio didn't fail Marcus. Marcus's liquidity plan failed him. And here's what makes this even darker. This isn't rare. 42% of Americans don't have an emergency fund at all, according to a US News survey. Additionally, 2 in 5 Americans wouldn't be able to cover a surprise $1,000 expense right now using cash or savings. 29% of Americans have more credit card debt than emergency savings, which means nearly a third of the country is in a structural condition where any unexpected expense, a car repair, a medical bill, a shortened work week, immediately converts to high interest debt. The clock starts running at 21% the moment it happens. This is the compounding mathematics of absence. Every dollar you don't have in cash when you need it costs you either the locked-in loss from selling assets at the bottom or the compound interest on whatever debt you take on to fill the gap. Both of those outcomes compound against you invisibly for years. The option isn't idle. The absence of the option is incredibly expensive. And here's the thing about that 21%. Americans paid $253.37 billion in credit card interest and fees in 2025, more than triple the $75 billion paid in 2021. The system is not broken. The system works exactly as designed. It just isn't designed in your favor. Cash doesn't wait, it aims. But if you don't have it loaded, someone else is aiming at you. Stay with me, because what I'm about to show you is the other side of this trade, and it's where the real money gets made. Every forced seller needs someone to sell to. And the person on the other side of that transaction, in every market cycle, in every asset class, at every price dislocation, is the person who has cash. Real estate is the most visible version of this right now. Per recent National Association of Realtors data, 27% of US homebuyers paid cash in March 2026, up from 26% the prior year. And the advantage a cash buyer holds isn't subtle. Here's how it plays out in practice. 2 offers land on a seller's desk simultaneously. Offer 1, $420,000, financed. Bank approval still pending. Appraisal contingency, financing contingency, 60-day closing minimum. The finance buyer can lose mortgage pre-approval between the offer date and closing. Employment status, credit score, or debt-to-income ratio can all change during underwriting. Offer 2, $400,000, cash, 7-day closing. No contingencies, no appraisal required, no lender underwriting. The deal either closes or it doesn't, and it closes fast. Which do you take? A lot of sellers take the $400,000, and they're right to, because certainty commands a premium. A cash buyer can beat a finance buyer on terms even when matching on price. The contingency waivers, both financing and appraisal, are the most common reasons real estate deals collapse. Cash buyers remove both by default. Now scale this principle beyond real estate because it applies anywhere a seller has a timing constraint or a liquidity need. Private business sales, distressed debt, equipment auctions, startup equity. In any market where someone needs to exit and needs to exit now, the buyer with cash has an asymmetric advantage. They can close fast, they can skip the middleman, they can offer certainty in an uncertain environment, and they get a discount, sometimes modest, sometimes dramatic, for showing up with money instead of with a promise. Here's a story that makes this visceral. In 2009, during the aftermath of the financial crisis, Warren Buffett was deploying capital at a pace that looked reckless to the press at the time. He put $5 billion into Goldman Sachs, not common stock, preferred stock, with a 10% annual dividend, plus warrants to buy Goldman shares at $91 each. Those warrants ended up being worth billions. Goldman was desperate. They needed cash. They needed certainty. Buffett had both. The terms reflected exactly that imbalance. He wasn't a genius in that moment. He was liquid. The option that had been sitting there quietly for years, he exercised it. You don't need to be Buffett for this to work. In the April 2025 market correction, the Liberation Day sell-off, the sell-off followed a similar script to prior corrections. Sharp decline, rapid rebound, vindication for dip buyers. Investors who had cash available bought index funds at prices 15 to 18% below their February 2025 highs. They didn't do anything sophisticated. They exercised the option they'd been holding. They pulled the trigger because they had something loaded. Now, here's where I want to push back on myself a little, because the standard financial advice is to stay fully invested. And that advice isn't wrong. If an investor had put $10,000 in the S&P 500 index on January 3rd, 2005, and left it untouched through December 31st, 2024, they would have amassed $71,750 for a 10.4% annualized return. That's real. Missing the 10 best market days during that same period would have brought the portfolio value down from $71,750 to $32,871, half the money, for missing 0.2% of trading days. But here's the thing that the stay fully invested crowd usually skips. 7 of the market's 10 best days occurred within 2 weeks of the 10 worst days, according to JP Morgan's data spanning the past 20 years. Which means the cash you need to buy the dip, the cash that lets you exercise the option you need it before the crash, not during, not after, before. If you're scrambling to raise cash the day the market is down 30%, you've already missed the trade. The setup happens in the boring months, not in the chaos. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Here's the part that never makes it into a retirement calculator. The numbers I've been talking about today, the forced sale losses, the bear market damage, the discount a cash buyer captures at the negotiating table, these don't exist in isolation. They're part of a system. And knowing the statistics is not the same as having a structure that converts them into a coherent plan. I spent a year working through 50 years of retirement data, sequence of returns risk, withdrawal rate research, healthcare cost escalation before Medicare kicks in, Social Security timing models. And I built a framework I call the Exit Code. It's a digital book. 8 chapters of pure research, no filler. It's built around one mathematical question. What does it actually take to exit the rat race? And when can you realistically do it? 2 of the things I cover in depth are directly relevant to what we've been discussing. The first is what I call the 4%. Trap, the rule everyone's heard that says you can withdraw 4% of your portfolio annually and never run out of money. The research behind it is real, but it assumes behavioral consistency that almost no one maintains. And it is catastrophically exposed to bad sequence of returns timing. If the market drops 25% in year 1 of your retirement and you have no cash buffer, the 4% rule doesn't protect you. The dynamic withdrawal method I walk through in the book does something structurally different, and it specifically addresses the liquidity question we've been talking about today. The second is the 58% rule, the finding that the majority of Americans exit the workforce before they plan to, typically due to health problems, layoffs, or caregiving responsibilities. If you don't have a cash and liquidity buffer embedded in your exit plan, that involuntary departure becomes a catastrophic sequence of returns event, not just a career disruption. The book has a specific buffer strategy built around this scenario. You can get the exit code for less than the cost of dinner out for two through the link in the description. If the numbers we're talking about today feel relevant to where you're headed, it's the cleanest distillation of 50 years of retirement data I've found anywhere. And I built it because nothing like it existed for the investor who doesn't have time for academic papers but needs the math to be right. Now, the reason most people get cash wrong isn't just that they hold too little. It's that they think about it as a single, undifferentiated pile. You either have savings or you don't. You're either in the market or you're not. But if you're actually building wealth with intention, and I mean a real intention, not just max my 401k and hope, you need to operate across three completely separate cash buckets. Each one has a different job, different sizing, different rules of engagement. This is where it gets really interesting, because the three buckets don't just change how you manage your money. They change your psychology around it. And that psychological shift, I'd argue, is worth more than the dollars themselves. Bucket one is the firewall. This is your emergency cash. Not an arbitrary 3 to 6 month rule, a calculated specific number based on your actual survival expenses, not your full monthly budget. Your survival number, rent or mortgage, utilities, groceries, insurance, minimum debt payments. Strip everything discretionary out. For most people watching this, that number falls between $12,000 and $28,000, depending on where you live and your baseline cost structure. The job of bucket one is exactly one thing: ensure you are never a forced seller. Every dollar in bucket one is doing precisely that. And the psychological research backs this up more concretely than most people expect. Among more than 12,000 Vanguard investors, those with at least $2,000 in emergency savings had financial well-being scores that were 21% higher than those without. That jump was the largest boost linked to any financial factor measured by Vanguard. Not investment returns, not income level, emergency cash. The presence of the firewall alone produced a measurable, category-level jump in financial well-being. That's not soft data. That's a structural finding. Bucket one lives in a high-yield savings account. The FDIC recorded the average APY across all savings accounts as of June 15th, 2026 at 0.38%. At the same time, there were a number of high-yield savings accounts offering APYs of 4% and higher. If your emergency fund is sitting in a Chase or Bank of America savings account, which, according to NerdWallet, many national banks offer an APY of only 0.01%, you are leaving roughly $400 per year uncollected on a $10,000 balance. That's not a rounding error. That's amused disappointment territory, if I'm being honest. The difference in one phone call. Now, bucket two. This is the opportunity fund. And this one is categorically different from bucket one, both in character and in risk of misuse. Bucket two is pre-positioned capital you intend to deploy when a genuine opportunity arrives, not a theoretical one, not the market is slightly down today, a real identifiable opportunity, a sector-specific correction that creates a measurably undervalued entry point, a distressed asset with forced seller dynamics, a private deal that requires fast capital and a short decision window. For the investor in their 30s or 40s with a growing portfolio, bucket two might represent 10 to 20% of your liquid investable assets, not more. You are not trying to call the market. You are trying to have ammunition ready for the moments when the market mispriced something in a way that's clear even to a non-genius. The failure mode for bucket two has two forms. The first is paralysis, holding the cash indefinitely, waiting for a dip that's big enough, watching corrections come and go, never actually pulling the trigger. The dip buyer needs two impossible things to line up: a correction on schedule and the nerve to act when everyone else is panicking. If you don't have predefined criteria for what constitutes an actionable opportunity, you will freeze. You will convince yourself the market will fall another 5%, and then it won't. The second failure mode is drift, using bucket two as a slow motion piggy bank, rating it for things that feel urgent but aren't opportunities. Bucket two gets spent on a vacation, a home renovation, an impulse investment in a friend's business. And then when the genuine opportunity arrives, the ammunition is gone, the gun is empty. The antidote is to write your trigger criteria down before you need them. What market decline percentage prompts action? What asset class? What valuation threshold? Not because you can predict the future, but because having a rule insulates you from the two worst human tendencies in investing: acting on emotion when you shouldn't, and doing nothing when you should. Bucket 3 is systematic deployment, the regular, boring, relentless process of dollar cost averaging into long-term assets. This isn't cash held static. This is cash moving through you on a fixed schedule, regardless of market conditions, regardless of how scary the headlines are that week. This is the bucket most people think of as investing. And the data is unambiguous about its superiority. Choosing 20-year periods between 1920 and 2020, dip threshold buying at 10% and 20% underperforms dollar cost averaging 74% of the time. Waiting for a 30% correction underperforms 73% of the time. The wait for the crash approach, which feels smart, which feels disciplined, which sounds like exactly what a sophisticated investor would do, is empirically inferior to showing up every month and buying at whatever price the market happens to be. That stings a little if you've been sitting on a pile of cash waiting for the right moment for the last 2 years, but it's the data. The three buckets aren't in conflict with each other. They're sequential. Bucket 1 funds itself first, always. Bucket 2 sits loaded, with clear rules for deployment. Bucket 3 runs automatically, regardless of what buckets 1 and 2 are doing. Most people never separate them. They have one pile, and they call it savings, and they feel vaguely guilty about holding it, or vaguely smug about having it, and they never really understand which emotion is appropriate. Now, here's the argument that I find genuinely underappreciated, even among people who think carefully about money. And I want to be blunt about the math, because the math is stark. Cash generates opportunity cost, real measurable opportunity cost. If you're holding $25,000 in a high yield savings account earning 4%, you're making $1,000 a year in interest. If the market returns 10%, you've theoretically forfeited $1,500 in unrealized gains on that $25,000. That's real. That's not nothing. But now let me tell you what's on the other side of that ledger, the side nobody calculates. For all credit cards, the average APR in the first quarter of 2026 was 21%. As of the fourth quarter of 2025, the average American credit card debt is $6,715. And Americans paid $253 billion in credit card interest and fees in 2025, more than triple the $75 billion paid in 2021. The median American is not paying opportunity cost on excess cash. They're paying 21% interest on essential purchases because they don't have a buffer. And 21% is not an opportunity cost, it's a destruction cost. At 21%, $6,700 in credit card debt generates over $1,400 in annual interest. Not compounding for your future. Gone. Let me put those numbers in direct competition. The opportunity cost of holding $4,000 in a high yield savings account, instead of in the market assuming a 10% market return versus 4% savings, is roughly $240 per year in foregone gains. The cost of not having that $4,000 when an emergency hits and carrying the balance on a credit card at 21% instead is $840 per year in interest. The math is embarrassingly lopsided. 3.5 to 1 in favor of holding the cash. And this is before you account for forced sale losses, bear market damage, or any of the opportunity dynamics we talked about earlier. You think the problem is the opportunity cost of holding cash. The actual problem for most people is the catastrophic and ongoing cost of not holding it. Now you're asking yourself, okay, so what does all of this actually look like with real numbers? Here's the case study. 2 people, same income, same savings rate, call them David and Rachel. David has $200,000 in his 401k and $50,000 in a taxable brokerage account, fully invested, no cash cushion. Rachel has the same $200,000 in her 401k, $40,000 in her brokerage account, and $10,000 in a high-yield savings account earning 4%. She earns $400 a year in interest, on that savings. David earned 0, but his 50,000 is fully deployed in the market. It's February 2022. The market starts dropping. In 2022, inflation in the US reached 9.1%, the highest since 1981. And the Federal Reserve's aggressive rate hikes pushed the S&P 500 into bear market territory, with a decline of over 20% from its January 2022 high. By June, both of them are down approximately 25% in their brokerage accounts. David's 50,000 is now 37,500 on paper. Rachel's 40,000 is now 30,000. Then David's transmission goes. $1,200. He sells stock to cover it. He locks in a realized loss. Those shares miss the entire recovery rally. Rachel pays cash from her savings account. She rebuilds it over the next 4 months. Her brokerage account sits untouched through the whole cycle. By December 2023, stocks had posted gains of 20% or more, entering a so-called bull market. David's account, minus the forced sale and its downstream effects on the recovery, ends up at roughly 46,000. Rachel's account, fully intact through the drawdown and recovery, ends up at 51,000. David lost $5,000 relative to Rachel. Not because he picked bad stocks, because he had no cash. The $10,000 buffer Rachel held, earning 4% per year, didn't just cost her $400 less in market gains. It earned her $5,000 in avoided forced sale damage. That's a 12.5 to 1 return on the cost of holding cash. This is what the compound return charts don't show. This is what the opportunity cost math doesn't capture. Cash is not defensive in some abstract sense. It's structurally generative. It creates conditions in which your long-term investments can do what they're supposed to do, compound without interruption, hold through volatility, participate fully in recoveries while simultaneously preserving your ability to act when the market hands you something genuinely good. Here's the thing. The financial advisor who tells you to stay fully invested is almost never incentivized to explain their fee is calculated as a percentage of assets under management. The danger of being a retiree or near retiree without a well-funded liquidity strategy, cash, and short-term bonds to maintain lifestyle is particularly potent. The advisor who keeps your money in the market keeps charging the fee. The advisor who tells you to build a $12,000 cash buffer in a separate high-yield savings account they don't manage. You see the incentive structure. Now, you might think, okay, but Berkshire is a special case. They're sitting on $397 billion because they can't find anything good enough to buy at current prices. That's an extreme example. And that's true, but the mechanism is identical, whether your cash pile is $397 billion or $37,000. Greg Abel told shareholders at the May 2026 annual meeting that he sees a unique opportunity for Berkshire's core businesses, but did not announce any major acquisitions or equity deployments. They're holding the option. They're waiting for the price they want. The Buffett indicator, which compares total US stock market capitalization to gross domestic product, sat at roughly 232% as of early July, with some measures reading closer to 238%. That reading places the ratio roughly 2 standard deviations above the historical trend, a level that has historically preceded significant market corrections. Berkshire isn't holding cash because it's scared. It's holding cash because the option value of $397 billion in liquid reserves at a market sitting at 2 standard deviations above historical norms is higher than the expected risk-adjusted return of buying equities at current prices. The cash IS the position. The option is worth more than the underlying right now. And here's the part that closes the loop on everything I've said today. Berkshire concluded 2025 with $373.3 billion in cash and cash equivalents. And they built that by quietly executing a 3-year net selling program. The conglomerate added to this pile by selling $24.09 billion in equity securities during the first quarter of 2026 alone, while purchasing only $15.94 billion, continuing a net selling streak that had persisted for over 3 years. While everyone was criticizing the accumulation of cash as timid, The most successful capital allocator in modern history was building the largest weapon available to any investor: the capacity to act decisively, at scale, at the moment of maximum fear. The mockery will stop when the dislocation arrives. It always does. Now, let me leave you with 3 practical things. Not generic, calibrated specifically to today. First, calculate your firewall number before you calculate your investment allocation. Not 3 to 6 months of your full lifestyle budget, 3 to 6 months of your actual survival expenses. Strip discretionary spending completely out. What you absolutely must pay to keep the lights on, the roof over your head, and the minimum debt payments current. That number is your bucket 1 target. Fund it before another dollar goes into the brokerage account. Because without it, every market correction is a potential forced sale. And forced sales are the hidden tax that most investors never see coming and almost never recover from cleanly. Second, open a high-yield savings account today if you haven't. Not tomorrow, today. The best high-yield savings accounts are hitting rates up to 4.5% APY as of July 7th, 2026. And that's genuinely impressive, compared to the FDIC's recorded national average of 0.38%. Many national banks offer an APY of only 0.01%, including JP Morgan Chase Bank, Bank of America, and US Bank. The same JP Morgan Chase that is currently charging its credit card customers an average of 21% annually in interest. The irony is so thick you could spread it. Don't leave the $400 per year gap sitting in their pocket. Third, write your bucket 2 rules down right now, before the next correction. What percentage market decline triggers deployment? What asset class? What is the maximum dollar amount you will deploy in any single event? Because when the market actually crashes 20 or 30%, the mood is not one of opportunity. Headlines scream. Portfolios bleed. The same person who decided they'd buy the dip continues to wait, convinced this time is different and the market will fall further. The cash stays in the bank and the bottom passes unnoticed. The rule has to exist before the fear does. Otherwise, the fear wins every single time. Lazy investing built more fortune than crypto memes. The people who win at this game over a lifetime aren't always the ones who pick the best stocks or called the right sector rotations. They're the ones who were never forced to sell the right ones. Cash is what makes that possible. It's not a bench player, it's not dead weight, it's the loaded option, the skeleton key, the fire hose with pressure already in it when the fire starts. The option doesn't expire, but the opportunity does.